Welcome to CIO Perspectives. I'm Sid All, the CIO of Private Client Endowments and Foundations here at Brown Advisory, and today I'll be joined by Erika Pagel, the CIO of Sustainable Investing, and we're delighted to have Bertie Thomson, a co-portfolio manager of Brown Advisory's global strategies in our London office, to join us. There's a lot going on in markets right now, so let's get right in. We've seen a meaningful rally in risk assets over the last few months in the face of what was some extremely bearish investor sentiment and positioning. Global stocks are up 12% from their lows, and the Nasdaq is up more than 20%. Markets are climbing the proverbial wall of worry. It appears that data on both the economic and company level has been better than what was baked in. For the first time in nearly a decade, even companies that missed earnings actually saw their stocks move higher. Recent positives include a strong U.S. jobs report for July and a CPI print that shows that inflationary pressures may be easing somewhat. So despite a tight labor market, continued inflationary pressures in the U.S., investors have responded positively to recent news. Stock market valuations have moved higher, and bond yields and inflation expectations have moved lower. But the backdrop may be a bit more challenging in Europe, where energy prices have skyrocketed and a recession may well be in the cards. So let me turn to Bertie, who has an excellent vantage point from London. Bertie, we are reading a lot about the energy crisis resulting from the war in Ukraine. Power prices are up 10x in Europe as Russia has slowed delivery of gas. Some economists are predicting not just higher prices, but maybe even rationing of power in the colder winter months, which could hit not just consumers, but also industrial companies and their ability to produce. What is your perspective, and how is the global equity team positioned as a result?
Thanks, Sid. Thank you for having me on the podcast. And it's a very important question that you raise at this moment in time. Certainly, when you look at the economic backdrop in Germany, it's been as gloomy as I can remember for quite some time. We spent some time looking at the IFO business climate survey. And in terms of expectations for the next 6 months, it's one of the lowest readings that we've seen since the financial crisis. In fact, if you exclude April 2020, as we went into COVID, it is actually the lowest expectations reading of CEOs of manufacturing and services companies in that region. So clearly, management teams are expecting a very, very difficult 6 to 12 months ahead of us. Now, a lot of it is due, as you mentioned, due to very, very high energy prices. So if you look at the Dutch gas contract, which is the market price basically for European gas, the TTF, that is up over 6x year over year. And German power prices today are at an all-time high. Now, a lot of this is due to the reliance that Germany and some other parts of Europe have on Russian energy. Some of this in Germany specifically is due to the decision made back in 2011 following the Fukushima disaster for Germany to decommission the fleet of nuclear reactors that they had. Part of this was because Chancellor Merkel was in a coalition with the green-leaning FDP party. So the country has migrated some of its energy towards renewables, but it's still reliant, as mentioned, or it still was reliant largely on Russian gas. So what is the economic impact of all of this? If you look at what the IMF expects, they expect if Russia completely cuts off the remaining gas supplies, for that to be a 3% headwind to GDP growth in 2023 for the German economy. And that's for an economy that is only expected to grow at 0.8%. So clearly, if Putin decides to turn the remaining of the taps off, then Germany will go into a recession. So clearly very difficult for both consumers and businesses. Some businesses have actually responded by shifting production internationally. BASF would be a good example of that. They've shifted some of their ammonia manufacturing away from Germany to the US to make to really take advantage of that energy arbitrage that exists in this moment in time. And in terms of how it impacts our companies, you really need to look at it on a case-by-case basis. Interestingly, some of the companies we invest in are actually benefiting from this situation. We invest in Deutsche Börse, which is an integrated securities exchange, and it owns EEX, which is the largest power exchange within Europe. They've obviously seen record volumes this year, and specifically their gas contracts have seen incredibly high volume activity in the very recent past in July, and that's hardly surprising. And we expect this company to benefit from the ongoing trend of trading to shift from OTC to on exchange. And if anything, this is probably one of the best times to push that forward, that the role of a clearinghouse becomes even really more important in this environment. So very much on a case-by-case basis, it's worth saying that Europe is home to some very, very high-quality businesses, and we would view any prolonged downturn or any drawdown in the equity markets as really an opportunity to buy a number of these high-quality businesses and increase our clients' exposure to them on what might be some temporary weakness.
So, Bertie, earlier this year, at the onset of the conflict, we made an asset allocation decision to reduce our exposure to Europe because of some of these risks. And I'm curious, from your seat, being able to invest anywhere in the world, how close are we to bargains on individual high-quality companies? And just, how has the market presented opportunities in the last few months?
Yeah, it's an interesting one because when you look at any individual country, you need to dig a lot deeper than just the index. One question we have had historically from global investors has been, why are you not more exposed to Europe? If you look at the P ratio on the Euro stocks, it looks very attractive versus the US. And the same questions come about Japan as well. Japan looks really, really cheap. Why are you guys not investing more in Japan? I think it's really important not just to look at like trailing P multiples or forward P multiples, but look at the returns of these businesses, look at the growth, look at the reinvestment opportunities they have, and also look at the individual constituents of each market. Specifically for Europe, we have seen some weakness this year, but Europe has also seen something of a quality premium for some of these companies. Technology as an example in Europe is a fraction. It's less than 3% of the Euro stocks, where it's 20% plus of the S&P 500. So high quality software companies in Europe typically trade at a big premium to those in America as an example. And it's the same with technology, hardware, and other high quality areas in consumer and industrials. So some of that premium is coming in. We're not seeing it come in to the point whereby we're really banging the table and seeing really attractive mid-teens IRRs, but it's certainly something that we're very much focused on. We have a ready to buy list of companies, and a number of them are based in Europe. The last point to make as well, depending on where you're located, is the euro has dramatically weakened versus the dollar this year. So if you look at it in dollar terms, you do see more attractive opportunities coming your way. But there's nothing, front and center of us at this moment in time that gets us super excited, not least with the rally that the market's had in the last couple of months.
Bertie, thank you for joining us today. While we're talking about the global outlook, let me ask you about your views on China. The zero COVID policy has taken a toll on China's economy, which had long been an engine of global growth. The People's Bank of China just cut policy rates, driven by slowing economic momentum, and there's headlines about rising geopolitical tensions surrounding Taiwan. How do you make sense of it all and think about these issues when managing a global equity portfolio?
Thanks, Erika. It's a really difficult question to answer, not least because of travel restrictions preventing us going to China, and we haven't been to China or actually had feet on the ground in that country for quite some time because it's so difficult to get in and it takes a long time to get out. But we're obviously speaking to companies that we own and also to companies that we might potentially own within the country. No question, as you touch on, that the economic environment is also getting cloudy. You mentioned the easing in the one-year lending rate that we've seen this week. I would expect more of that to come. Industrial production seems like it's slowing down. Retail sales came in slightly weaker than expected. And as you mentioned, youth unemployment is very, very high indeed within that country. So it's a difficult situation that the administration over there have to deal with. We would expect more and more stimulus. We would, funnily enough, probably expect more and more populism as the economy slows down. We've seen this most dramatically with some of the technology companies, whereby they have been reprimanded both through regulation but also being forced to contribute to different social funds and essentially cough up to what we think are largely artificial misdemeanors of the past. So I think there's almost like a sort of social revolution going on within the country, starting from the top. Obviously, we've had the middle class growing, but it's very much about other parts of the society being integrated and benefiting from the wealth that the country has delivered over the last 10 years. Growth in the country is slowing, as I mentioned, slowing from an historic 10% growth that I can remember a few years back to around 3% this year. That's what the IMF expects. We have no crystal ball about whether it's going to be a hard landing or a soft landing. And we are, very much focused on the quality companies that have exposure to China. Now, a number of those aren't actually listed in China. A couple of them are listed in Hong Kong. And we also access China through our investments in other parts of the world as well. And we're really looking for companies that will benefit from the growth in consumption and really providing products such as life assurance, cosmetics or elevators that are quite hard to get otherwise through domestic players. And we still see the long runway for growth for those businesses. So still an exciting country, but no doubt going through a cyclical slowdown. And there are some political and social issues that they have to deal with as that economic growth slows down and as the administration tries to keep the growth going.
Bertie, maybe we can drill into a few company examples. What about Taiwan Semiconductor, a company that you hold in a few strategies? It's obviously deeply intertwined into these dynamics that you just discussed, and I know you've studied the situation closely.
Yeah, TSMC is an incredibly important company for the future of the world. They are by far the largest foundry producer, and they have a very, very strong position in the cutting edge, low nanometer advanced node chips that are produced that go into everything from an iPhone to other advanced applications. And they really are head and shoulders above anyone else in the industry. Now, when you look at the political situation with China viewing Taiwan essentially as part of the country, unfortunately, or I guess fortunately for the Taiwanese, there is something of a Mexican standoff. China is heavily reliant on Taiwan and on TSMC, not only for importation of chips, but also those chips go into a number of products, such as the iPhone, that are made in China. So the whole ecosystem is inextricably linked with each other. I think with Speaker Pelosi going over and visiting the country recently, that was probably an unnecessary goading of the administration over there. And we were certainly concerned about the military activity that was conducted. But I think for us, the reality is that there is no way really to extricate each one of these countries from the situation that they're in. They are both heavily reliant on each other. And we think the saber rattling will probably continue. But we don't think that a conflict is part of our base case. But when we do our scenarios and we think about cost of capital for a company such as TSMC, we do reflect this heightened country risk in the discount factor that we use when we're discounting the cash flows that the company produces, irrespective of the fact that they are selling these products globally and largely in dollars.
So basically, Bertie, you're saying for a company like that, or a company in emerging markets, you're just going to use a higher discount rate. Future cash flows will be valued at a lower value today when they're coming from a higher risk country or jurisdiction.
That's right. And, as a reminder, we use a 10% cost of capital for developed markets and a higher one for developing markets to account for country risk and frequently also for currency depreciation as well. So the hurdle for a Indian company, a Brazilian company, or a Taiwanese company getting into our strategy is obviously a lot higher on that basis. We also look at probabilities around the cash flows as well. And need to spend a lot of time looking at bear cases not least in China and other parts of the world, whereby they have different corporate governance systems, they have different rule of law, and they have a very different approach to private property rights. So yeah, it's a very important part of our analysis, and also comes back to what I was describing earlier. When you look at the multiple of certain countries around the world, you need to remind yourself that, a P ratio in India or in China should very rightly, everything else being equal, be lower than one in America or Europe, because to account of what you're touching on, country risk and also currency depreciation.
Maybe pivot back to just what we've seen the last few weeks in the market. I mean, Bertie, you talked about it as things maybe were getting a bit more interesting and maybe less so as the markets moved higher. Erika, you and I have talked a lot about this. What's been going on the last few weeks in the market? Why have we seen this rally since the end of June? And is this a bear market rally, or is it something more substantial?
Well, we are approaching a 20% rally on the S&P if you look at lows compared to in mid-June. And there's a couple of things happening. Number one, investor sentiment had become overly bearish, especially leading into second quarter earnings season. Secondly, inflation and interest rates have driven the direction of the markets for most of this year. And what we've started to see is more influence from corporate earnings that are now playing a larger role in driving market returns. So a couple things that we look at, much of a company's reaction to earnings results is often predicated on expectations that are either currently priced in or heading into the print. So oftentimes, not so great news or bad news can often be good news. And we've said for a while that resetting forward earnings expectations would actually be welcome news for the market. And we actually started to see that for the first time in June. So heading into early July, you did start to see negative earnings revisions for the second quarter for the S&P 500. If you excluded energy, which is having a disproportionate impact on S&P earnings this year, second quarter overall earnings were actually negative. And things are really moving very fast right now. Just in the past 3 weeks, we've seen 2022 earnings estimates come down from nearly 9% to roughly 8%. And so that is absolutely helpful in thinking about all the valuation and multiples, that have been quite volatile so far this year. We still think that back half of 2022 and 2023 estimates are at risk of more revisions. But I think right now, when you look at 2023 consensus forecasts, they are painting a more soft landing picture. So you've got revenue growth up a few percent at 3%, with earnings up close to 8%. So that really implies that, analysts are expecting an economic slowdown, slower sales growth, but also declining cost pressure, declining inflation, which would result in, some better earnings. And then lastly, the inflation print was better than feared. And we started to see some moderating increases within a few important areas like energy.
It's really interesting. That is kind of a prediction of the opposite of what we've seen thus far in earnings, which has been kind of revenues surprising, maybe a little bit to the upside, but all those cost pressures eating into corporate margins, kind of an aggregate basis. Maybe quickly we could touch on the Inflation Reduction Act. And maybe for you, Erika, there's a lot of news coming out about this. It could have implications in many areas, but particularly in kind of energy transition and your area of expertise and sustainability. Could you just tell us your quick takes on this bill?
Yeah, in the U.S., the Infrastructure Investment and Jobs Act, the IIJA, as well as the Inflation Reduction Act of 2022 should help to spur investment in climate and clean energy. So the Inflation Reduction Act is landmark legislation. It's the biggest climate investment in the U.S., and the act includes roughly $369 billion on climate and energy policies. So a few areas of focus are there's a goal to cut carbon emissions by 40% by 2030. The Act looks to provide wider accessibility to clean energy with the goal of lowering renewables costs, as well as increasing U.S. competitiveness in clean energy. So there's provisions for investments in renewables, provisions for retrofits, incentives to buy electric vehicles. There's tax incentives for companies to build solar panels, batteries, to process critical minerals. But there's also tax credits for low-income Americans to purchase electric vehicles, rebates for those that increase their home energy efficiency. So overall, this is good news for the clean energy industry. It's a game changer. And subsequently, clean energy, electric vehicles, solar stocks, they've seen a nice bounce heading into and following this vote. So the Wilder Hill Clean Energy Index is up more than 35% just in 1 month. And then there's some certain solar stocks that have rebounded nearly 50%. And many of these companies will benefit from these provisions and tax incentives.
So there's been a lot of discussion about some of the kind of fiscal spending that's gone on the last few years and the impact on inflation. Do you have any views as to whether or not what we're seeing here will be inflationary or deflationary? Is this going to help us or hurt us? And maybe there's a difference between the near term and the kind of medium or longer term impact here?
Yeah, so there's no doubt that some renewables initially carry a higher cost of capital. And many companies from a business standpoint need to weigh that cost of capital over time. What we have seen, really over the past 10 years is many areas of renewable energy like solar, that cost has come down. But there are many different areas that can help us get to lower carbon emissions. Many technologies, there'll be new technologies that will come out. This act hopefully helps to provide well-needed incentives, whether they're rebates or tax incentives that will help promote investment, particularly early on investment or CapEx, that will ultimately lead to lower costs in the future. So, I think overall this will be disinflationary in the long term. Initially, as a lot of these technologies start to ramp up, the initial cost may be slightly higher. Sid, let me turn to you. I know you've also been following inflationary dynamics very closely. We touched on the environment a bit, but inflation is very high. The CPI print in July remains above 8%. When do you think inflation will start to moderate? And what does this mean for Fed policy going forward? Do you think we're going to be able to execute a soft landing?
I think a lot of it depends on your definition of soft landing. I think a true soft landing in my mind is kind of one where you still have solid growth and inflation is contained. I think by some definitions, we've kind of already entered a recession in the US. We've had 2 straight negative quarters of GDP growth. It's just a very odd one that probably won't be considered an official recession because unemployment is less than 4%. The labor market is really strong. So it's a really unique situation. I will say, by the Fed's own calculations, financial conditions have tightened in this hiking cycle at the fastest pace in 40 years. So talked about this internally as kind of, slamming on the brakes. This isn't just the Fed hiking rates. This is kind of the markets responding to that and credit spreads increasing and just the cost of capital increasing pretty quickly. I do think it does matter what kind of recession we're talking about. If I think a soft-ish landing is one where we're avoiding a kind of deeper recession. And I think there's a pretty good chance that we do avoid that. We have a really strong consumer. I think the Fed appears to have regained some of its credibility. We certainly have a much sounder banking system than we had in 2008 when we saw a very deep recession. Just generally, I'm a lot less concerned today than I was in 2008 or even 2020 when we were facing incredible unknowns with the pandemic. I'd say what Bertie was talking about earlier in Europe, what we've talked about with China and emerging markets, the weakness in economies outside of the U.S. Does continue to kind of concern me. It can weigh on global growth. And I think we're finally reaching a point where high inflation is starting to really pinch the consumer. So we've seen some pretty big jumps in consumers borrowing. So people using their credit card to kind of keep their spending pace amidst higher prices on everything from food and electricity to consumer goods. So wages are rising quickly. We've talked about that a lot, but they're actually not keeping pace with inflation. And so I think it will get harder for the consumer to remain as strong as they've been. I think there is no doubt a lot of positive to be taken from the last print. So really the last print was month over month. For 1 month, we had no changes in headline prices. But if that happened every month for the rest of the year, we'd still end 2022 with over 6% inflation. That's way above the Fed's 2% target. And as we've talked about, there are a lot of elements of inflation that are probably going to remain pretty stubborn. So, inflation is also a highly unpredictable beast, so to speak, is a lot of behavioral considerations on top of just the monetary and fiscal ones. So, and the stubborn elements, we've got 5 million more job openings than we have unemployed workers. So there's just a huge gap in the labor market that can continue to put upward pressure on wages. And then in the housing market, we've had a huge rise in mortgage rates and hence a decline in affordability. And we've had years of undersupply of new homes following the financial crisis. And those are two dynamics that could lead to just kind of continued further upward price pressure on rents. So right now, we're kind of at this moment where the market is telling us the Fed's got this under control. Long-term inflation expectations have come down a lot. Almost 1% per year. Expectations have fallen in the last 3-4 months if you look out 5 years. So market's also now pricing in the Fed's going to pivot and start lowering rates early next year. That still seems like a pretty rosy outlook. And I guess I would say that I think there's still some risk to the upside in inflation, and we want to be positioned accordingly.
1 month of better than feared inflation is certainly not a trend. Persistent inflation has created unique challenges for asset allocation and how we manage client portfolios. Many clients often use a playbook of a 70-30 portfolio, which is 70% stocks and 30% in fixed income. Sid, is that a playbook for today?
It's a good question. It's one that comes up more and more, where people are saying, do we need to think kind of radically differently about this environment? I think we do need to think differently. These are the highest inflation rates we've seen in 40 years. The first half of this year was the worst period in that same 40 years that we've seen for a 70-30 or 60-40 portfolio. Bonds have really struggled to provide that kind of diversification and downside protection because yields are just so low. And by the way, even though yields have come up a lot, they're still very negative on an inflation adjusted basis, right? We've got 2-3% bond yields and we've got 8% inflation right now. So our view has definitely been we need a bit of a different playbook. We need more tools in the toolkit going outside of just stocks and bonds. So this is why we've either introduced or increased things outside of pure stocks, things like real estate, infrastructure assets, absolute return hedge funds that can be uncorrelated to stocks and bonds. And we've also tried to put a real premium on business quality and balance between strategies like growth and value. The value stocks tend to be less sensitive to high rates of inflation and higher interest rates, and certainly moves higher in both of those things. So we've also tried to keep the duration in our bond portfolios shorter, given the risk of rising rates. And interestingly, right now, the yield curve is not just flat, but it's a little bit inverted at the front end, which means that very short-term bonds have better yields than some bonds further out the curve, and that's based on what we were talking about before, this kind of rosy expectation right now that the Fed's got everything under control, inflation's going to come down, the economy is going to slow. And so people expect lower rates of inflation and will accept lower yields in the future. So I think we do need a new playbook, but I think we've stopped short of the 1970s playbook where you would have a massive allocation to areas like commodities, just because I don't think it's our job to plan for one potential outcome. I think it's our job to think about many different outcomes, because predicting which one we are going to get is really hard. It will depend on how entrenched inflation is in people's minds. It will depend on what the Fed does. It will depend on some of the geopolitical issues that we've been talking about. So there are a lot of different outcomes, but one of the ones we need to prepare more for than at any time over the last 40 years is just structurally higher inflation.
Yeah, the markets today seem to be moving on macro issues, which is something that we haven't seen in quite some time. Bertie, let me turn to you. You often look for high-quality companies with pricing power, those that may be better positioned in the current market environment. How are you seeing companies respond in this inflationary period?
Yeah, it's interesting. So the way that we look at pricing power is really through the lens of what we call willingness to pay. So we are looking for companies whereby the price that they're charging today is substantially below the theoretical walkaway price that the customer has. And the reason that we want that is we want companies that we feel deliver huge amounts of value to their customers. The reason that we want that is that it means that the customers come back time and time again. And to your point about pricing power, that also enables either steady like-for-like pricing power, so prices that go up every year, or it enables them, such as we saw with Microsoft earlier this year, to increase prices in a step function. Both of those things are an incredibly important tailwinds for compounding, but also from a defense perspective, they're incredibly important when you have an inflationary environment such as today. So pretty much all of our companies have been able to pass price, pass certainly the inflation they're seeing in their cost base through with price. But actually what's interesting is that we're seeing a number of other companies in other sectors that we wouldn't think traditionally have pricing power being able to do that as well. Because as we've just been talking about, inflation is everywhere. It's on the front page of all the major newspapers. Therefore, the ability to pass price is not necessarily something that's unique. But the ability to do it through a cycle is a lot harder, and those are the companies that we're really looking to invest in. What I think is something that is overlooked by many other investors is not only the impact that inflation has on cost bases when we're talking about an operating cost base, such as labor and cost of goods sold, but also what were we going to see when it comes to capital cost inflation. So really where the cost of replacing a company's plant keeps going up, the amount of inventory a company has to hold keeps going up and up and up. That obviously has a dramatic impact on the return on equity or the return on invested capital that the company can generate. You are starting to see that in companies' inventory. I don't think we've seen it to the extent whereby it's really depressing returns at this moment in time, but I would certainly be laser focused on companies that feel that they have to spend more and more on CapEx to deliver the same unit volume of products to their customers. Because what that means typically is that the return on invested capital of those companies will be coming down, and that'll mean that these companies end up becoming less valuable. So operating cost inflation is something that we are seeing across the piece, but we're also laser focused on capital cost inflation, which I think is the missing part of the conversation when we're talking about pricing power and the ability to pass price.
So Bertie, what are you hearing from companies? What are some of the most kind of interesting observations that might give insight into, the strength of the consumer or, business trends that might be helpful?
Yeah, it's interesting. We've had the majority of our companies report their second quarter results. And we typically, as I touched on earlier, look for companies whereby they deliver a tremendous amount of value to their customers, and they're really trying to solve a problem for those customers and consumers of their goods and services. I think when you look at the picture, there is still a lot of opacity coming from the aftermath of the pandemic. I hope it is an aftermath, but it certainly looks like it is at this moment in time, which creates, a bit of a foggy picture. When we look at, as Erika was touching on, the consumer, we are also seeing a shift away from big ticket items and durable goods to more experiences. So we have suffered some sort of underperformance over the last couple of years, or some headwinds from a number of our companies who are exposed to travel. Visa would be a good example of that with its cross-border travel. We also invest in Safran, which is the leading manufacturer of narrow-body aircraft for air travel. And they make all their money really from when the aircraft engines get serviced. Both of these businesses were severely impacted in the pandemic. And what we're seeing is what can only be described as a let out of jail syndrome of sorts, whereby the consumer wants to travel, they want to see the world, they want to experience things. And actually travel has rebounded much faster than we expected it to. Indeed, cross-border volumes for someone like Visa are above where they were in 2019 last quarter. And for someone like Safran, narrow-body air traffic is recovering at a much faster rate than we thought it was going to. So, there's a interesting sort of tailwind coming out of the pandemic. Who knows how long that's going to last? But as you touched on earlier, Sid, unemployment still remains very, very low. And against that backdrop, we are still seeing a lot of value within the companies that we invest in. We've been busy adding a handful of new companies to the strategies earlier this year, but we've actually taken pause with some of the rally that we've seen, not only because we're seeing less attractive companies on our ready to buy list, but also because from an opportunity cost perspective, we are seeing tremendous value within our strategies. And when you look at a strategy like Global Focus, which is our concentrated 10 to 15 company strategy, if you look out 5 years on our conservative numbers, the strategy trades on less than 10 times cash flow, about 8.4 times cash flow, which is one of the lowest multiples on a 5-year basis that we've ever had since we started the strategy 5 years ago. So we do think that time is one of the very few advantages, if the only advantage you have in investing. And you need to buy good companies that serve their customers in a special way and really look out as far into the future as you possibly can and be comfortable that those companies will deliver their cash flows. And that's really how you'll end up making money slowly. So that's very much our approach. And we're seeing a lot of value within the strategies, within the companies that we invest in at this moment in time.
It's an interesting dynamic. I mean, high quality companies compounding their intrinsic value because they're growing cash flows, revenues at a nice clip when the market is down 20% and they're growing that intrinsic value perhaps by a similar amount. I mean, you really are getting a much bigger discount than perhaps it appears for those high quality companies that are compounding that value. It's interesting.
And especially if they can deploy those cash flows in value-added ways. Very few company managements that we meet, I'd say less than 15% of management teams that we meet actually think like investors. If you have a management team that can add value through buying other companies that are depressed at this moment in time, or that can buy back their equity that is dramatically undervalued, or can invest back into their business, that's a great tailwind for growing that intrinsic value. And those are the management teams that we really seek. Managers that think like investors. So this has been a fascinating discussion, and thank you very much for having me on the podcast. I spend my life looking very much on a micro basis of individual companies. Erika and Sid, I'd love to ask you both about where are you seeing opportunities, either on a geographic or asset allocation basis?
I mean, you touched on this earlier, Bertie, but in May and June, I think we were getting some really interesting opportunities on a kind of company by company basis to buy great companies on sale. Prices have now moved pretty quickly higher. I think still what we hear from our internal and external managers is there are very good 5-year returns available today in quality companies with the kind of pricing power, competitive positioning that we want in a high inflation and more uncertain environment. So, that's the core of most portfolios, and we still feel really good about it. So, that opportunity still feels good. That's one of the reasons we haven't, become more bearish or more defensive despite all of these concerns. We almost got to a place where corporate credit, including high yield, was interesting. I think we may get there in the coming quarters. So, we've kind of been preparing some strategies that could take advantage. That's historically been one of the best asset allocation, opportunistic trades that we've made over multiple cycles is, when the spread of credit to treasuries gets wide enough, if you have a reasonably long view, you can make some great alpha. We're not quite there yet, but hopefully soon. People have heard me drone on about this a lot in the past. I think biotech and life sciences is still a really interesting spot. I know these are companies, Bertie, you I'm sure never look at. Many of them have very little in the way of current revenues. Some have no revenues currently, but they have potentially really interesting pipelines of drugs. Most investors avoid this space entirely because of the challenges of evaluating the science. We've been getting more and more interested in this space because we found some of these specialists, and the market has been absolutely destroyed over the last 18 months, and there are record numbers of companies trading below the cash they have on the balance sheet, some of which they raised in recent IPOs. And we finally started seeing this catalyst of M&A activity with big pharma companies using their $500 billion with a B of buying power to buy their future growth in this space. So I guess that probably the last thing I've been thinking about is, I think we could be entering a much more interesting period for private equity, particularly buyout, perhaps early stage venture. Certainly a much more interesting period than we saw the last couple of years when I think valuations were running quite hot. We try to be pretty programmatic about this. We don't try to time this market. But some people's inclinations in a period like this is to really pull back. I think we want to continue to be programmatic, and companies may struggle a bit more in this period. I think that bodes well for the kind of typical buyout playbook.
Yeah, we continue to watch three primary areas. So diversification, deglobalization, and decarbonization. So Sid touched on diversification, really preparing ourselves for an environment that will have a wide range of outcomes. Deglobalization, Bertie touched on that a lot, specifically as it relates to energy security. And then decarbonization, for a while now, we've been focused on ways to invest in the energy transition. And in our view, energy infrastructure presents an interesting long-term opportunity, particularly given the shifts in the geopolitical environment and renewed impetus on that energy security. So energy infrastructure across traditional fossil fuels as well as renewable energy sources will be instrumental to Europe's goals of energy independence from Russia. We also like infrastructure from an asset allocation standpoint for that diversification element, but also as a way to generate income and inflation protection, and frankly, a hedge to higher commodity prices. So we've recently, utilized an investment strategy that integrates ESG, environmental, social, and governance factors throughout their entire investment process and in their portfolio construction. And their focus is on decreasing fossil fuel powered assets and directing capital expenditures towards renewables. Looks like we're coming up on time, so that is all for this roundtable. Stay tuned for our next discussion. Thanks for joining us, Bertie, and thanks to all for listening.
Thanks, Bertie.
Thanks for having me on.